All right, today we're going to talk about a really dangerous assumption that trips up so many traders. We're going to move past some of those old static strategies and explore a much smarter, more adaptive way to look at the markets. This is all about trading smarter, not just harder. Come on, we've all been there, right? You see a price drop, you think, this is it. It's a bargain. It's totally oversold. So you jump in, you buy, and then you just watch in horror as it keeps on sinking. It's got to be one of the most frustrating feelings in trading, and it points to a huge flaw in a really common strategy. And here's the real heart of the issue. Standard mean reversion, it's built on this idea that an asset will snap back to its normal price. But here's the thing. In the markets today, normal isn't some fixed point. It's a moving target. It's constantly shifting because of new information, changing volatility, new trends. What was normal last week might be completely irrelevant today. So if that old rule is broken, what's the fix? Well, let me introduce you to the challenger, the Kalman filter. Just think of it as a super smart, adaptive way to figure out what an asset is really worth moment by moment. So what in the world is a Kalman filter? Okay, at its core, it's this clever algorithm that's designed to be a master observer. Its whole job is to look at the complete chaos of the market, all that day-to-day noise, and constantly fine-tune its best guess of an asset's true underlying value. It's basically learning and adjusting in real time all the time. Now, here's probably the best way to get your head around the difference. A simple moving average? That's like using a paper map you printed out last week. Sure, the route is there, but it's based on old, stale information. The Kalman filter, on the other hand, is like the GPS on your phone. It knows exactly where you are right now, and it's constantly recalculating the best route based on live traffic. It's totally dynamic. Okay, so how does this filter actually find that true value? Well, the secret sauce is its incredible ability to separate what's important, the signal, from all that random short-term market chatter, the noise. So here's how it works. First off, every time a new price comes in, it updates its estimate. It's never out of date. Second, it smooths out all those wild knee-jerk price swings, so you get a much clearer picture of what's going on. And third, and this part is absolutely crucial, it adapts to how choppy the market is. If things get crazy and volatile, the filter knows it and it adjusts its thinking.
So how do you actually use this thing? It's a surprisingly simple three-step process, really. 1. The filter gives you the dynamic mean, that constantly moving true value. 2. As new prices come in, that mean updates itself. 3. Your job is just to watch for moments when the actual price strays too far away from that dynamic moving target. That's your signal.
And this brings us to the showdown. Why does this dynamic approach give you such a massive edge? Well, because in trading, being able to adapt isn't just a nice little feature, it's the whole game. This quote just nails the core advantage. A standard indicator might be screaming oversold, but in reality, a powerful new downtrend has just started. The Kalman filter, because it's always updating, is way more likely to see that new trend forming. It'll actually move its true value estimate down along with the price, which keeps you from stepping right in front of a freight train.
Look at the difference. The standard approach is stuck looking in the rearview mirror. That makes it so prone to fake outs, right? Where you think you found the bottom, but you're just catching a quick breath in a bigger downtrend. You end up fighting the market. But the dynamic approach, it adapts in real time. This cuts down on those fake outs big time because it's designed to move with the trend, not against it.
Look, what this all boils down to is this. Using a dynamic mean gives you a much, much better chance of avoiding one of the biggest mistakes in trading, trying to catch a falling knife. You're not just betting on a return to some old average anymore. You're trading based on where the value is right now. So if you remember just one thing from all of this, make it this. The future of trading isn't about rigid, fixed rules. It's about building systems that adapt to the market's constantly changing reality. It's time to stop using yesterday's map to find your way through today's world.
And that leaves us with a final thought to chew on. This whole idea of dynamic thinking, it doesn't just apply to mean reversion. So what other timeless investing rules are you following that might be seriously overdue for a modern adaptive upgrade? The answer to that could completely change how you see the markets.